Hello, and thanks for joining me, Louise Gookey, for this latest episode in our top tips for home buyers. Today, I'm going to be digging into long-term fixed-rate mortgages, what they are, why you'd consider one, and where the pitfalls lie. Now, whenever we're talking mortgages, my first piece of advice is to make sure you speak to a mortgage advisor. Mortgage terms vary depending on your personal circumstances, so you need to be sure you're getting the deal that's absolutely right for you. We've popped a link below that will connect you with professional, experienced advisors. And make sure you subscribe to this channel so you don't miss any of our home buying updates. So let's start with the basics. Your mortgage term is the lifespan of your mortgage until it's paid off. A mortgage term of 30 years or more is considered a long-term mortgage, and anything less than 20 years is a short-term mortgage. The advantage of a longer-term mortgage is that because payments are spread over more years, the monthly payments are lower. As house prices have risen and mortgages have become less affordable, long-term mortgages have become more popular. A long-term fixed-rate mortgage is simply a long-term mortgage in which the interest rate you pay is fixed for a certain amount of time, usually 2, 5, or 10 years. How long to fix the rate for comes down to a number of considerations. Do you think interest rates will rise or fall over that period? Are you likely to move home? Even though you can often move the mortgage with you, there can be implications if you're on a fixed rate or if your personal circumstances have changed. Also think about whether you might want to borrow more for home improvements, for instance, because if you do, that could be a different rate to your original mortgage. Until 2021, the most popular type of mortgage was a fixed rate, 30-year mortgage. However, as interest rates rose dramatically, people felt less inclined to lock in higher interest rates. Nevertheless, there are still advantages in a long-term fixed-rate mortgage. For many home buyers, it's simply the peace of mind of knowing how much your repayments will be each month for a certain length of time. It helps you manage your monthly outgoings, and even if interest rates rise, if you're on a fixed rate, your mortgage payments are going to stay the same. Long-term fixes and longer-term mortgages also mean you can save the time and money it costs to remortgage when your deal ends, because you won't have to do it as often. On the downside, if interest rates drop, you won't benefit if you're on a fixed rate. And if you do decide you want to change mortgage because you're moving or want to switch to a better deal, then you'll probably have to pay an early redemption fee. Remember that a long-term fixed rate is a long-term commitment. So if you're likely to relocate or upsize because you're expecting a family, you might find this kind of deal too inflexible. And of course, a long-term mortgage is a long-term debt. If your goal is to own your home outright as soon as possible, this may not be the right move for you. Even if your mortgage is long-term, the fixed interest rate won't last as long as the mortgage. So whenever your deal comes to an end, you'll need to secure a new one, probably at a different rate. There's a lot to consider. So as I said at the beginning, do make sure you have an in-depth chat with a mortgage advisor so you can make an informed decision with confidence. Stay with us because we have more property-related advice coming up.